Imagine you're building a tower out of blocks with your friends. Everyone's stacking blocks higher and higher, and it's working great. But then someone realizes they can stack blocks they don't actually own. They borrow blocks from other kids, promising to give them back later. Soon, everyone's doing it. The tower gets massive. It looks incredible. And then one day, someone asks for their blocks back. That's basically what happened in 2008. Except the blocks were houses, the kids were banks, and when it all fell down, millions of people lost their jobs, their homes, and their savings. Let's start with something simple: how normal people buy houses. You don't usually have $300,000 sitting around. So you go to a bank. The bank lends you the money. You pay it back over 30 years, plus interest. The bank makes money. You get a house. Everyone's happy. This system worked for decades because banks were careful about who they lent to. They had to be. If you didn't pay them back, they lost money. Their own money. So they asked questions. They verified your income. They made sure you had savings. They required a down payment, usually 20% of the house's price, to prove you had skin in the game. But in the early 2000s, something changed. Housing prices were going up. Not just a little. A lot. Every year, houses were worth more than the year before. In some cities, prices were climbing 10, 15, even 20% annually. People started thinking this would never stop. It felt like a law of nature. If you bought a house for $200,000 and it was worth $250,000 a year later, you just made 50 grand by doing absolutely nothing. So people wanted in. Everyone wanted in. Your neighbor was making money. Your coworker was making money. Even your cousin who barely graduated high school was suddenly talking about investment properties. Banks saw this and thought, we can make a lot of money here. Normally, banks would only lend to people with good credit, steady jobs, and a down payment. These were called prime borrowers. Safe bets. But there weren't enough prime borrowers to satisfy the demand. The housing market was hot. Everyone wanted a piece. So banks started lending to subprime borrowers. People with bad credit. People without steady income. People with bankruptcies in their recent past. People who absolutely could not afford these houses under normal circumstances. Why would banks do something so risky? Because they didn't plan on holding the risk. Here's where it gets interesting. In the old days, if a bank gave you a mortgage, they kept that mortgage. Your monthly payments went to them for 30 years. If you didn't pay, that was their problem. They'd lose money. They might have to foreclose on your house, sell it at a loss, eat the difference. It was messy and expensive. So they were careful. They had every reason to make sure you could actually pay them back. But by the 2000s, banks had figured out a new trick. They could sell your mortgage to someone else. They bundled thousands of mortgages together and sold them to investors as something called mortgage-backed securities. Imagine taking 1,000 loans, mixing them all together like ingredients in a blender, slicing that mixture into pieces, and selling those pieces on the stock market. Investors bought these pieces because they paid returns, and they seemed safe because they were backed by real houses. Real assets. What could go wrong? Here's the key: once the bank sold your mortgage, it was no longer their problem. If you stopped paying, the investor who bought that mortgage-backed security would lose money, not the bank. The bank already got paid. They got their money up front, the moment they sold the mortgage. So now the bank's incentive completely flipped. They didn't care if you could actually afford the house. They just wanted to make as many loans as possible, sell them off, and collect fees. Volume became the goal. Quality became irrelevant. This is when things started getting truly insane. Banks hired armies of mortgage brokers. These brokers went out and found anyone with a pulse. Didn't have a job? No problem. Couldn't prove your income? No problem. No down payment? No problem. They created something called ninja loans. No income, no job or assets. Yes, that was a real thing. People were getting $600,000 loans while working part-time at Starbucks. Or claiming to be self-employed with no documentation. The application might as well have been written in crayon. They also created adjustable rate mortgages with teaser rates. You'd pay almost nothing for the first 2 years, then the rate would reset to something much higher. The pitch was simple: don't worry about the reset, just refinance before it happens. Housing prices are going up, so you'll have more equity. You can always refinance into a better loan. It sounded reasonable if you didn't think about it too hard. And the brokers doing this weren't necessarily trying to trick people. They were responding to incentives. They got paid per loan. More loans meant more money. The system rewarded volume, not quality. If a broker had moral qualms about giving a loan to someone who clearly couldn't afford it, well, there were 10 other brokers who didn't. The industry selected for people willing to play the game. But wait. If these loans were so obviously risky, why did investors keep buying them? 2 reasons. First, housing prices kept going up. As long as that continued, it didn't matter if someone couldn't afford their mortgage. If they stopped paying, the bank could just take the house back and sell it for more than the original loan. The house itself was the safety net. The collateral was appreciating. Even a bad loan on a house that kept increasing in value wasn't really that bad. The math worked as long as prices rose. Second, and this is crucial, the people buying these mortgage-backed securities had no idea how risky they actually were. This is where Wall Street got creative. The banks didn't just bundle mortgages and sell them. They sliced them into different levels of risk, called tranches. The safest tranche got paid first. If homeowners made their mortgage payments, that money went to the top tranche before anyone else got a cent. The riskiest tranche got paid last. It only got paid if everyone else got paid first. Obviously, the top tranche was safer. It had priority. The bottom tranche was basically absorbing all the risk. Credit rating agencies, companies whose entire job was to evaluate risk, gave the safest tranches AAA ratings. That's the same rating as US government bonds. The absolute safest investment you can make. The kind of thing pension funds and insurance companies are required to buy because it's so safe. But here's the problem. The credit rating agencies were paid by the banks creating these securities. Think about that for a second. If you're a teacher and your students pay you based on what grade you give them, what grades are you going to give? If an agency gave a bank's product a bad rating, the bank would just go to a different agency. There were 3 big agencies, Moody's, Standard & Poor's, and Fitch. They competed for business. So they had every incentive to slap AAA ratings on things that absolutely did not deserve them. They were grading their own customers' homework, and their customers were paying them to give good grades. The agencies defended themselves by saying they used sophisticated mathematical models. They had PhDs running complex algorithms. But the models were based on historical data from a time when mortgages were actually underwritten properly. They didn't account for an industry that had completely abandoned standards. Garbage in, garbage out. Pension funds, insurance companies, and foreign governments bought these AAA-rated securities thinking they were safe. They had no reason to doubt it. The math was complicated. The products had names like collateralized debt obligations. The rating said AAA. Everything looked fine. These weren't idiots making these purchases. These were sophisticated institutional investors relying on a system that was supposed to work. Except it wasn't fine. Then Wall Street did something even more reckless. They created synthetic versions of these securities. Basically, bets on whether the original securities would succeed or fail. These were called credit default swaps. It's like selling insurance on a house, except 100 different people could buy insurance on the same house, even if they didn't own it. If the house burned down, all 100 people could collect. This created unbelievable amounts of leverage. The total value of these synthetic bets became vastly larger than the actual mortgages underneath them. AIG, one of the world's largest insurance companies, sold billions of dollars worth of these credit default swaps. They were essentially insuring mortgage-backed securities, promising to pay out if those securities failed. They thought it was free money. After all, housing prices don't go down nationally. That had never happened in modern American history. So they collected premiums and didn't bother setting aside much money to actually pay claims. Why would they need to? If you're starting to feel like this sounds unstable, you're right. By 2006, the whole system was a massive tower of borrowed money, bad loans, false ratings, and abstract financial products that almost nobody fully understood. Investment banks were leveraged 30 to 1 or more, meaning they had borrowed $30 for every dollar of their own money. Hedge funds were even more leveraged. The entire structure was balanced on a pinhead. And it was all built on one assumption: housing prices would keep going up forever. They didn't. In 2006, housing prices stopped rising in many markets. Then they started falling. Not everywhere at once, but in enough places to matter. Suddenly, people who took out mortgages they couldn't afford were stuck. They couldn't refinance because their house was now worth less than they owed. This is called being underwater. They couldn't sell because nobody wanted to buy. Their adjustable rate mortgages reset to higher payments they couldn't make. So they just stopped paying. At first, it seemed like a small problem. A few subprime borrowers defaulting. No big deal. Defaults were expected. That's why the securities were sliced into tranches. The bottom tranches would absorb the losses. The top tranches would be fine. The system was designed for this. But remember, those mortgages had been sliced up, bundled, sold, and resold so many times that nobody knew exactly who owned what. A pension fund in Norway might own a piece of a security that contained a fraction of a mortgage on a house in Nevada. And that house was now worthless. The homeowner had stopped paying. The house was in foreclosure. But which specific mortgage-backed security did that bad mortgage end up in? Nobody could say for sure. The whole thing was too complex to untangle. If you enjoyed this video and want to understand more about how the world actually works, hit that subscribe button. We break down complex systems without the jargon. As defaults increased, the value of mortgage-backed securities started dropping. Banks that owned these securities had to mark down their value. This created losses. Big losses. And because these banks had borrowed heavily to buy these securities in the first place, small losses got amplified into catastrophic ones. If you borrowed $30 to buy an asset worth $31, and that asset suddenly drops to $28, you're not just down $3. You're completely wiped out. Your entire dollar of equity is gone, plus you still owe $2 you don't have. Here's where the real panic started. Banks didn't just lend money to homeowners. They lent money to each other. Every night, banks with extra cash would lend it to banks that needed it, just for one day. This is called the overnight lending market, and it's essential for the financial system to function. Banks need this liquidity to balance their books, meet regulatory requirements, and fund their daily operations. It's boring and technical, but it's the plumbing that keeps everything running. But in 2007 and 2008, banks started to worry. If they lent money to another bank overnight, would that bank still exist tomorrow? Did that bank own a bunch of toxic mortgage securities that were about to blow up? How much exposure did they have? The banks themselves didn't even know their own exposure half the time, so how could anyone else? Nobody knew. So banks stopped lending to each other. When banks can't borrow money, they can't function. They need to borrow to lend. That's how banking works. You deposit money, they pay you interest, then they lend that money to someone else at a higher interest rate. But they don't keep all your money in a vault. They lend most of it out. If you and everyone else suddenly wants their money back, the bank doesn't have it. They need to borrow from other banks to meet withdrawals. If they can't borrow, they collapse. Credit froze. If you were a business that needed a loan to make payroll, too bad. If you wanted to buy a car and needed financing, tough luck. If you were a city that needed to issue bonds to fund infrastructure, forget it. The entire economy runs on credit, and credit stopped flowing. It was like someone turned off the water supply to a city. Everything just stopped. In March 2008, Bear Stearns, a major investment bank, collapsed. They'd made huge bets on mortgage-backed securities and couldn't meet their obligations. Normally, they'd borrow to cover shortfalls, but nobody would lend to them. The Federal Reserve and the Treasury Department helped arrange an emergency sale to J.P. Morgan for $2 a share. A year earlier, Bear Stearns stock traded at over $160 a share. The government justified the intervention by saying Bear Stearns was too interconnected. If it failed in a disorderly way, the panic would spread. Everyone thought that was the worst of it. It wasn't. Over the summer, things deteriorated. Fannie Mae and Freddie Mac, the quasi-governmental entities that guaranteed most mortgages in America, were on the brink of collapse. The government took them over in September. Then, on September 15, 2008, Lehman Brothers, an even bigger investment bank than Bear Stearns, filed for bankruptcy. It was the largest bankruptcy in American history. The government didn't step in this time. They let it fail. The logic was that bailing out every failing bank would create something called moral hazard. If banks know they'll be rescued no matter what, they'll keep taking insane risks. They'll privatize profits when things go well and socialize losses when things go bad. Someone had to be allowed to fail to send a message. So Lehman was allowed to collapse. The market completely panicked. If Lehman could fail, anyone could fail. Stock markets around the world crashed. The Dow Jones dropped more than 500 points in a single day. Credit markets seized up entirely. The commercial paper market, which businesses use for short-term borrowing, essentially stopped functioning. Companies that had nothing to do with mortgages or housing couldn't borrow money to operate. AIG, one of the largest insurance companies in the world, was about to collapse because it had sold all those credit default swaps and now had to pay out billions of dollars it didn't have. The government reversed course the day after Lehman failed and bailed out AIG with $85 billion. Later, that bailout would be expanded to over $180 billion. The government now owned 80% of AIG. Why save AIG but not Lehman? AIG was even more interconnected. It had sold insurance to basically every major financial institution. If AIG collapsed, it would trigger failures across the entire global financial system. Lehman was bad. AIG would have been apocalyptic. Then the government bailed out the banks. $700 billion in total through something called TARP, the Troubled Asset Relief Program. The idea was to buy up the toxic assets and stabilize the system. Congress initially voted it down. The stock market dropped 777 points in a single day, the largest point drop in history at the time. Congress reconvened and passed it. The bailouts worked, kind of. The financial system didn't collapse entirely. Banks stabilized. Credit markets slowly unfroze. But millions of people lost their jobs anyway. The unemployment rate hit 10%. People lost their homes. Retirement savings evaporated. The economy went into the deepest recession since the Great Depression. It took years to recover, and even then, the recovery was uneven. Some people and some places never really recovered. And here's the uncomfortable part, almost nobody went to jail. The executives who ran these banks, the brokers who made the loans, the rating agencies that lied about risk, they mostly walked away. Some lost their jobs. Some lost bonuses. Dick Fuld, the CEO of Lehman Brothers, lost a fortune on paper, but he'd already made hundreds of millions over the years. Most of the others landed on their feet. But the legal system didn't really hold anyone accountable because it's hard to prove that what they did was illegal. Reckless? Yes. Stupid? Absolutely. Immoral? Arguably. But illegal? That's trickier. They were following incentives. The system rewarded short-term profit and pushed risk onto others. They played the game as it was designed. The rules allowed it. The regulators didn't stop it. Everyone else was doing it. If you didn't, you'd lose market share and your shareholders would revolt. The system didn't select for ethics. It selected for aggression. So what actually caused the crisis? It wasn't one thing. It was a chain. Cheap credit from the Federal Reserve made borrowing easy. Rising home prices made risk seem invisible. Mortgage brokers made bad loans because they got paid to. Banks sold those loans because they could shift the risk. Rating agencies blessed the securities because they were paid by the banks. Investors bought them because they trusted the ratings. Wall Street amplified everything with leverage and synthetic products. Regulators didn't stop it because they believed markets would self-correct and they didn't want to be blamed for killing a boom. Politicians encouraged homeownership as policy. And everyone, at every level, assumed housing prices would never fall. Each individual decision seemed reasonable at the time, given the incentives. But the system as a whole was insane. The crisis revealed something uncomfortable about how modern finance works. Complexity hides risk. When products become so complicated that even experts don't fully understand them, bad things happen. When the people making decisions don't bear the consequences of those decisions, bad things happen. When profits are privatized but losses are socialized, bad things happen. When everyone believes something can't fail, that's usually exactly when it does. The 2008 crisis wasn't a random accident or an unforeseeable black swan event. It was the predictable result of a system designed to prioritize short-term gains over long-term stability. A system where the people who caused the damage were protected and the people who had nothing to do with it paid the price. The bankers got bailouts. The homeowners got foreclosures. And the strangest part? Many of the same dynamics still exist. Banks are bigger now than they were in 2008. Too big to fail became bigger and more entrenched. The regulations that were passed after the crisis, like Dodd-Frank, are being rolled back piece by piece. The credit rating agencies still get paid by the banks. Leverage is back. Complex financial products are back. The people who lost everything didn't get bailed out. The system that broke didn't really get fixed. It just got stabilized enough to keep running.